Welcome, everyone. My name is Axel Snowfall. I'm editor-at-large at Reuters, based out of London. I'll be moderating today's webinar entitled Episode 2, Forex News and Currency Analysis in Association with Reuters. We're going to run about 45 minutes or so. There will be plenty of time for Q&A, so do send through your questions. Few housekeeping bits I want to go over. At the bottom of the screen, you'll see a toolbar. I'm sure you're all well aware of this. You can use that to access a range of applications, biographies, resources, etc. Submit your questions via the Q&A box. I'll try and get to as many of those as I can. For the best viewing experience, close any programs or browser sessions running in the background. Some networks do cause slides to advance a little bit more slowly, so logging off your VPN is also recommended. And finally, we do value your feedback, so please complete the pop-up survey at the end of the webinar. Let's get straight in. I want to introduce our three speakers today. Sujato Rao is Deputy Markets and Financial Services Editor for the EMEA region at Reuters. Martin Miller is a Senior Currency Analyst for FX Buzz, and Richard Pembleton, Trading Market Development over at Refinitiv. Thanks to all three of you. And all three are going to add a little bit of a different flavor. Martin very much on the technical side, Sujato some of the fundamentals, and Richard, I think, a mix of both. But Richard, I want to kick it off with you. As Refinitiv, you run the world's, I think I'm right in saying, deepest single pool of FX liquidity used by all client segments for all FX asset types. You spend a lot of time speaking to clients. How has the current context in which we're operating changed things for them?
So, thank you. I think if we have the first slide up, we can have a quick look at the volumes. And we can see that these are the highest volumes that we've seen in a very long time, and that is obviously there was a lot of activity in the market. One of the positive things, obviously, through this difficult time was venues saw a lot of requests as customers and clients were looking to hedge their exposures in the market. And during that month of March, we saw significant increase in volumes, but the amount of bandwidth that was going through the systems was around 400% higher, maybe 500% higher, depending on whether it was the interbank or the FX market. So I think one of the positive pieces out of these troubling and unprecedented times is venues have held up pretty well. On the flip side of that, by everybody working from home, access to tools have changed quite dramatically. People don't necessarily have access to as many screens, so therefore the layout and the access to as many venues may have changed. So therefore, one of the feedbacks we've had with clients has been that the liquidity has become a lot thinner. So therefore, hunting around in the market has become to get a good price has been more of a challenge. Spreads have widened, therefore it becomes more costly. So how this has probably expedited some of the sort of operational or project plans that they were focusing on for this year to either become more digital, rely less on phone, because there was nobody at the other end of the phone or they couldn't get access at the time. So therefore, looking at more relationships as well, maybe less reliant, because liquidity is thin. Previous liquidity providers from the buy side may not have been able to accept certain amounts of risk in the market. So therefore, people had to hunt around a lot more. And as a response for that, multi-bank portals were being adopted a lot higher. Aggregation was being adopted a lot higher. And we've seen an increase in algos to be able to manage those orders slowly into the market, trying to get the best price. Obviously, we've heard about best execution and transaction cost analysis being very in vogue from a regulatory standpoint over the last 12, 18 months. Some firms had maybe not adopted that in as much rigor in the past, but they're certainly looking into that now to try and optimize the way that they go to market more so. And particularly here in Asia, where there's no mandated regulation, it's more best practice. They're hunting to try and improve P&L.
Sure. All right, thanks for that, Richard. Sujato, let me come to you. I want to segue to the volatility piece. I know it's something you've been looking at, you've been writing about as well. It's traditionally pretty low given where rates are, given the sort of stimulus we've seen. We did have a spike in volatility in March. I think we hit record highs, in fact. It's still relatively high. What is the picture a month or two out from now, would you say?
Wow, month or two out from here, it's like this, as I say, if you can't predict the future, just invent it. Okay, I'm not going to do that, but it is a little bit baffling because FX vol is around the index of FX vol is around 8%, I think, at the moment, which is half of what it was in March at the height of it. But it is still very high compared. It's kind of in line with its historical averages, let's say, but it's very high compared to where it was for the past few years. And in February, it fell to a record low. And given the way interest rates are now stapled to the floor, amount of liquidity that's going through markets, it's still high given all that. But the possibility is that this is the market where people are expressing their the uncertainty that's out there still in terms of the outlook with the U.S. elections, with the coronavirus, etc. So that's where it is, and I suspect that vol might remain high until the U.S. elections are passed.
Okay, and we'll
find a vaccine. That's the other thing. Yeah.
Yeah, we'll come on to the US elections a little bit later on. Clearly, euro-dollar is a story you're writing a lot about, and I know you did a live blog about 30 minutes or so ago. You're looking at US real yields coming off, but of course German real yields are coming off as well. Now that to many would suggest the end to the euro-dollar rally. I've got a poll which I'm going to put out to the audience in just a second, but what the people you speak to, are we seeing an end to euro-dollar rallying now?
Well, it's all mixed, really. Yes, the market is probably divided, but there's a swing now towards thinking that the rally might be running out of steam. So several reasons. You mentioned the real yields, but obviously that's not the only thing. Yeah, there's a couple of...
getting a little bit of feedback from your mic, actually, Sujata. Can you hear us okay?
Yeah, I can hear you. Can you hear me now?
Yeah, that's good. Go ahead.
Okay. So there's various factors that we had the stimulus deal from from Eurozone, from European Union, which probably helped lift the euro. And you have a number of that impact has now been factored in. German yields have caught up with US real yields, so they're as low as US, if not more. And chances are that, and as many people point out, 10% is not that big a deal within cyclical euro-dollar rally currency moves. So it can be 40%. So 10% up and down can happen within that. And very significantly, some people who've been very bearish on dollar have actually changed their views. People like Morgan Stanley, for example. So there is reason to think that it might be slowing, if not stopping. We might just wait for a while to see what happens next.
All right, Martin, I'll get to you in just a second, but let's just put out this first polling question, see where the viewers stand on euro-dollar in particular. The polling question is up on your screens. After 7 weeks of declines, is the dollar spell of weakness over? Just a simple yes or no response. So have an answer of that one, and I'll bring you the results as soon as they come through. Martin, let me come on to you. You look at this very much from a technical perspective, but both the fundamental and technical pictures for the dollar are bearish right now, it seems. Run us through what you're saying on the dollar.
Right, okay, so obviously the dollar is normally seen as a safe haven asset, but these are very, very complex times, and the market has been selling it quite aggressively recently. So while the dollar's outlook is I would say, quite mixed, both from a fundamental and technical standpoint, the market positioning shows that the market is increasingly stretched. So in the short term, the market is vulnerable for a swing higher, and that's purely because of the positioning of people trying to reverse their positions that they built up over a reasonable amount of time. Mm-hmm. So the dollar, if you look at the dollar index, if that should be up on the screens now, what that shows is that the dollar has basically been falling quite aggressively since March. And it's actually been falling since the US was recording 10,000 new COVID cases a day, and at the same time, the S&P has been rising. So people have been building up their short positions, and yes, we could have a situation where it does reverse. It was quite negative in terms of the technicals. So if you look back in June, there was a death cross where that's the 50-day moving average falls below the 200-day moving average, and that's always deemed as a negative sign. So the expectation is that from that point of view, the market is very bearish. Obviously, the fundamentals, as Sujata was saying, seems to suggest that there could be an element of a reversal, but I'm not so sure that that is going to be sustained in the medium term.
Yeah, sorry, go ahead, Mark. Go ahead. I know Sujata wants to come in, but go ahead.
Sorry, no. So the longer term, the medium term saw the market absolutely collapse, and the dollar index actually is looking bleak because it saw the biggest one-day slump in a decade, and in July it closed below a very key moving average. Sorry, a very key Fibonacci level. So it was a 61.8% retracement of the 2018 to 2020 rise. So overall, medium term, I would suggest that you'd be selling the rallies on the dollar, and that you could see the dollar index dropping down to around 90. But as we've been saying, the positionings show that the dollar has created its biggest short in over 9 years. So that is the reason why people are getting a bit jittery, and the expectations are that there could be a reversal higher. But again, I think this will be a short-term thing. So those positions will be shaken out, and then we'll have to reassess where the US is with COVID and how they are responding to it as compared to, say, the biggest other currency out there, the euro, and how the European Union are also coping with it. One thing to note, though, with the euro is that people are quite sceptical about it. Some people are saying that they don't believe that this can rival the US dollar as a safe haven. But this year it's been remarkably well behaved. So we've got a plot here of the daily returns for the dollar index, euro dollar, dollar yen, cable, and Aussie. And if you look very closely at the euro dollar, you'll see that there are not many observations that are, below 2% or above 2% of a move in a day. Whereas if you look at some of the other currency pairs, so traditionally dollar yen is seen as a safe haven. That has been very volatile compared to the euro. So the euro is actually at the moment behaving very similar to the actual dollar. Now, I know that the euro makes up the vast majority of the dollar index, so it's almost like a reverse of the dollar index. But in and of itself, it is moving it is actually much more well behaved than other currency pairs. So that is one reason why I would think that investors might, regardless of the fact that they built up a large position, they might see this as a safe haven. So therefore, the euro would be a good thing to buy on the dips. But we could go into the euro in more detail.
Oh, all right, Martin. Thanks for that. Sujata, I know you wanted to come in and say something on euro dollar, right?
Oh, it's just about the dollar. I totally agree with Martin that the coronavirus is going to drive things. If European countries see big outbreaks, lockdowns, we're going to see everybody back in the same boat again. But the thing I wanted to add was on the dollar. There's some people who think the dollar isn't actually that weak. It's fallen 10%, but if you look at it, that's against the dollar. Look at it against, if you look at it against on a trade-weighted basis, which is against the currencies of its trade partners, it's actually up on the year. It's up around 3%, I think, according to the Fed, the index the Fed uses. And the other thing to remember is that the last time U.S. real yields were so low, were below Germany's, or you had minus 1.3% or something like that. You had the dollar index was a lot lower than it is now. So it was like 20 points lower than where it is today.
Okay, thank you,
so
Sujata.
That leaves some people think it's not weak at all.
And by the way, the polling came back pretty much smack on 50-50 yes and no. So clearly people are undecided as to where we're going to go. Martin, do you want to add anything on? Oh, actually, no. Now yes, we've changed a bit. No, the no's, i.e. The dollar spell of weakness is not yet over, are on 63%, and those who believe it is, that spell of weakness is over on 37% is where we stand right now. Did you want to add anything else on the euro? I mean, clearly the stimulus plan that Sujata mentioned has pushed this ever and ever closer to being viewed as a safe haven currency, the euro. Did you want to add anything else on the euro?
Oh, absolutely, yeah. So, as I said, it's basically the other side of the coin for the dollar. And actually what Sujata said was quite interesting, because from a trade-weighted point of view, it suggests that there is room for the dollar to actually fall even further. So that in itself is another thing where you could say, well, there's a good chance that euro is a buy on the dips. I see no evidence at the moment as to why the euro would reverse dramatically. Yes, it can do in the short term, over the month or so, but over the longer term, I think there's a good chance that it can continue to head higher. Now, I've put on the screen now a daily euro-dollar chart which shows the golden cross that happened, and that basically shows that the market was getting quite much more positive about it, and that's led to the break higher. However, the fact that it didn't break 120, and the fact that at the moment we have a very large long position in the euro. I think it's the biggest ever euro long position in euro futures. So there's a good chance, yes, you can get a dip back in the near term, but longer term, the expectation is that we head higher. My expectation is that it should be enough eventually to see the euro head towards 120. There's a 121 Fibonacci level, which is 76.4% of the big drop that happened between 2018 and 2020. So I think the likelihood is that we will head there. There's an element where the options market is showing that there is a little bit of with risk reversals. There could be a little bit of a dip, because risk reversals are an options contract that show that how much volatility premium dealers are adding for strikes in one direction versus another. Yeah. And euro calls for the 1 month risk reversals, they hit highs not seen since the March panic buying. They got up to 0.4. However, since then it's dropped back down to about 0.5, which suggests that for now there's a top in place in the euro. But as I said, I believe this will be a short-term phenomenon over the next month or two. So effectively, my expectation is to buy dips for another run up at the 120 option barriers, and then it breaks, and then a break above there. I just want to do one quick thing, which is to show again the returns of the euro when you compare that with dollar yen and cable. So at the moment, okay, you've got the ballooning speculative long position in euro dollar, which suggests there could be some type of structural shift that's underway. But obviously we've got the short-term positionings, which short-term those positionings could limit the upside as well as the options. And that because they'll actually, when you have an increase in long positions, you'll get more of a preponderance of associated offers and also sell stops. But yeah, the actual returns show that euro dollar itself is stable in and of itself, and which increases its utility at a time when, some investors need to have a shelter away from the coronavirus pandemic.
Sure. All right. Sajada, I don't know if you wanted to go, or Richard, come in and just say something briefly on the euro, because I want to move on to the yen in just a second. Either of you want to add anything?
I can. Okay. Who wants to go first? Richard, you want to go first?
More of a question. Obviously, spread with liquidity being thin and confidence is slowly returning, but obviously it's very, very fragile. Spreads are still relatively wide on the wider side. Is there any kind of indicators of showing that sentiment that there's a little bit more confidence coming back into the market with any of the stories or the fundamentals that you've seen? Or is it still very much very thin ice?
What do you think, Ron?
Oh, for me, I think at the moment everything is still on tenterhooks, to be honest, because there are so many different elements. There are so many things out there that could disrupt the market. So you obviously you've got China trade, you've got Brexit, and you have a big unknown with this pandemic as well. And you throw into the mix the US election, and that has massive ramifications across the board. For example, you have a re-election of President Trump. There could still be disruptions in global trade, and that in itself can feed into people getting out of riskier assets and into assets that are seen as more stable. Yeah. So there's so many different things that are up in the air. We're in unprecedented times that things could change, just overnight.
In fact, Sajada, just before I get your thought, actually, Sajada, give us your thoughts on the euro very, very briefly.
Okay, very briefly, I just want to say that the crisis showed us how important the dollar is to the world economy. Everybody, when the chips are down, that's the currency you want to be in. But from that, I think what's going to change is that people are going to be looking for alternatives, because that's really highlighted the need for alternatives. And the euro has shown that it can be an alternative now, because now we are seeing greater Eurozone cohesion with this big EU recovery fund, and what is different, what is game changing about this is that it's going to be funded by issuing debt together jointly. So that creates a joint European Union debt instrument, which can be used as a safe asset by central banks, as a reserve, for their reserves, right? So that was what was hobbling the euro's rise as euro's role as a reserve currency. 750 billion is a very small amount, but if it's just a start, and if it grows, here you have a euro-denominated safe asset which people can buy for their reserves, and I think its role is going to grow even if it doesn't displace the dollar. Over the long term, that's going to happen.
Yeah, can I add a little bit to that, actually?
Yeah, very quickly, Man.
Yeah, sorry. So the euro share of currency bank reserves, they're reported by the IMF. They were around 20% in the first quarter. So it'll be interesting to see if there's any sort of change in that. So if you see an increase in that, that will start to corroborate the story that the euro could become a rival to the dollar.
Okay, good. Thank you very much indeed for that. Let's move on to the yen. Martin, I know dollar yen shorts panicked a little bit. When was it? The end of July, when the BOJ warned against a rapid rise in the yen. Where are we since then?
Yeah, so since then it's actually stabilised. But the thing with that is that my expectation is that it's in a holding pattern at the moment. So the dollar yen speculative short position has grown rapidly, but it shows that there is a risk in the very short term that it could reverse slightly. But overall, I think that the yen is always an asset that is sought in times of uncertainty. So my expectation is that we will see dollar yen continue to fall in the medium term. One thing I'd say about August, I'll show you this seasonality chart. Now, remember with seasonality, one thing you should remember is that you can't use it in isolation. So, but it is useful when you combine it with other factors. So in August, the performance has shown that dollar yen has actually fallen in 14 of the last 20 years. So that's something to bear in mind. So as I said, in times of uncertainty with risk aversion still around, that should help to keep a lid on dollar yen on the upside. And dollar yen actually dropped below, if there is a dollar yen drop below last month's low, then the expectations are that we could see it getting down back towards 100 into the end of the year. So that's my overall expectation, is that it's a good thing to actually sell the yen on a rally and keep yen in your possession, so that you can guard against more worries that are around the corner.
Yeah. Okay. Good. I want to move it on to sterling, and Sujata, let me start with you on sterling. We're at 5 months highs or thereabouts, despite worries over No Deal Brexit. Is there a Brexit premium in the currency? What's the story you're writing on sterling right now?
What we're saying is sterling's defied gravity for weeks now, or if not months. And when does the reckoning come? And it might come at the end of August, because we've got talks. It depends on what other stories are out there, because markets have been preoccupied with coronavirus, et cetera, et cetera. And so sterling has been lifted by dollar's weakness as well. So it all hinges on a bunch of other stories. One, will the dollar turn? Two, will coronavirus news calm down a little bit? Or will there be more lockdowns, et cetera? And how will the talks go in mid-August on the Brexit trade deal? Because if those don't go well, we're going to have some issues, because the deadline is coming into view now. So, and if you want to see a Brexit premium, you can see it in euro sterling, because euro dollar has risen like 5% in July, I think, but against the euro, sterling rose 5% against the dollar in July. But against the euro, it did almost nothing. So that's where your premium is. But you can see it in other assets as well. You can see it in, say, equities which have underperformed U.S. and European equities. So there is a little bit of a premium, but I think it's going to come to the fore a bit more after these talks, and also given what dollar and coronavirus do.
All right, and from a technical perspective, it looks there's quite a lot of scope for gains, it seems. And I'm just looking at some of your charts. I know you're going to pull them up because you say that the drop, the typical drop we get for sterling against the dollar in August is unlikely to happen this year. What makes you think that?
Because one, obviously, my expectation is that the technicals look quite positive. So okay, let's put to one side the what's happening with the dollar. So with the dollar, it's up in the air, but with the pound, it has been very strong against the dollar, not against the euro, but against the dollar. So the pound actually, cable registered a monthly close above the key Fibonacci level, % of the 2018 to 2020 drop. So therefore, there's further scope for gains towards 135, which was a peak in December. So that's my expectations. But I do actually agree in terms of the fundamentals that there are a lot of things out there that can trick traders up that are long. So one thing I would say, though, is that in terms of market structure, micro structure, you can see that that last week speculators actually squared up some of their short positions. So that in itself can actually help, because the fact that, okay, there's still shorts out there that can be taken out and that can push it up, but eventually there will be a limit. It's just a case of when. But in terms of Brexit and in terms of worries about uncertainty over that, that is the biggest risk. And overall, I would be, very dubious of a rally carrying on much above 135, 136, unless there's a little bit of an overshoot.
Okay. Sujata, come on.
Hey, so just one very, very quick thing. It also depends on what the Bank of England says, because we've had they sounded fairly upbeat last month, and they said this month, and they seem to rule out negative interest rates for the time being. So will they go down that route? That's going to be very important for way sterling moves. So far, it doesn't look like they will.
Okay. And Richard, you wanted to mention something a client said.
Yeah, I was having a chat the other day, and they said previously when we discussed with our quants, what is the optimal number of liquidity providers to request for a price? Typically, it was somewhere between 5 to 7 to close the spread as much as possible based on different pricing models. As a result of the volatility and the thinness of the market, they now have to poll a few more banks. It's no longer that kind of 5 or 7, depending on the currency. It's moved up to 6 to 9, which might not sound a big thing, but it's actually quite a big difference from what's happened previously. So it's just a reflection of the thinness of the market and how hard it is to find a price now.
Okay, that's sterling. Let's move on to the Aussie dollar. Martin, back to you. We got a central bank downgrade on the economy last week, I believe it was. They warned on jobs as well. Second wave of coronavirus infections. Melbourne, of course, back into extended lockdown. What's this doing to the fundamentals, and what do the technicals tell you now?
Well, it just highlights that there's an issue here. So we saw basically the Aussie dollar closed above a key fibber again, and that would suggest, from a purely technical point of view, that it's going to continue to head higher. But the risk, the thing about the Aussie is that it's buffered by risk. So we have to be very, very careful. The other thing with the Aussie is that the performance normally suggests that in August it falls most of the time. 15 times out of the last 20 years it's fallen. So that is a thing that people have to bear in mind. It's a very risky currency to hold. So from a technical point of view, I would say, yes, it's a buy. But conversely, from a fundamental point of view, you have to be very, very careful, because in times of uncertainty, funds normally go out of the Aussie dollar. And as the Aussie is very, very susceptible to trade tensions, if you have any flare-up or a further flare-up in the trade tensions between the US and China, that will also have a detrimental effect on the Aussie.
Yeah.
One other thing, again, I want to show you this. So with this one, the daily returns of the Aussie dollar versus the dollar index. And what that shows you is that you do sometimes, not very often, but sometimes you have big drops to the downside. So if you look at that, there's one that was even close to a daily 4% drop in Aussie. So that shows that the Australian dollar is much more volatile than the US dollar, and it is susceptible to some brutal trading, and that might tie in as well with liquidity. So in this time of coronavirus, that is not a good asset, in my opinion, to be holding.
So certainly not a shelter in the times of pandemic.
No.
Okay.
It doesn't give you a yield either these days, does it? It used to be a high yielder, and now it isn't.
Mom? Used to be a
exactly.
high yielder, now it's no longer a high yielder?
Yeah, that's right. And so, and that's the thing. So why would you hold it? So the only suggestion, the only reason why you'd hold it is purely from a technical point of view. But if you need to have more confirmations of holding it, you're not going to get it for now.
Okay. And look, the final currency we want to look at from a technical perspective is the Turkish lira. that came off as well against the US dollar on the back of steps taken by the authorities, given the recent market volatility. What are the charts telling us about the Turkish lira market?
Right. So with this one, we're in this currency is in unprecedented times, so therefore we're at record lows for the actual lira. So what we have to do is we have to use other tools to try to gauge where it could actually be going, because obviously, clearly, the momentum is squarely on the upside. So for dollar against Turkish lira, there's a Fibonacci projection that I've constructed, and that can unearth a new level. So the level that it's projected to get to is just below 9. So it's quite a bit of a sell-off for the lira I'm expecting in the months ahead, and that is an extension from it's 100% extension. And if you take if you see the A, basically I've got the letters on there. So it's an extension from C, and it's 100% of that move from A to B, and that target is just below 9. So that's my expectations for that. And also, if I just show you this chart here, so this one is actually a little bit out of date now, so it should be a little bit higher than that. But the benchmark 1 month risk reversal shows that the TRIBE puts over calls have doubled to 10 volts. So basically it costs you a lot more to hedge the upside in dollar Turkey than the downside, which is obvious. But remember that risk reversals they're an options contract that shows you the volatility premium that dealers will add to strikes in one direction or the other. So that shows you that the expectations are that we'll see further weakness in the lira.
And a question comes through, Martin, from someone watching. Will the Turkish lira's drop be a concern for the euro?
To be honest, the euro is such a large currency that I don't believe that it will, to be honest. No, I don't think it will. I think that the biggest concern for the drop in the lira is to the Turkish economy. It's going to be massive for them, because they also have quite a few geopolitical problems. They've got problems with the US, they've got problems with Russia and Syria, and they've got some trading problems with Europe. So I think those are a bigger concern. The biggest concern for the drop in Turkish lira is definitely domestically.
Mm-hmm. Okay.
Sorry.
Go ahead. Yeah, go ahead.
I just wanted to say that if it hadn't been for, I agree with Martin, if it hadn't been for coronavirus, right, affecting tourism, I think there would have been an issue for the likes of Greece or Spain, which compete with Turkey for the Mediterranean tourism market. But at this point, nobody's going anywhere. So the lira depreciation isn't going to help Turkey very much.
Mm-hmm. All right. I want to just take a step back. And in fact, I want to just put another polling question out there. I've got a wary eye on the time, but a polling question, and just talk very briefly to finish up with about some of the other big picture macro stuff. The polling question is this one. We have touched on this, but it'd be interesting to get your views on this. If Trump wins re-election in November, what will be the impact on the dollar? Will it be a positive one, a negative one, a neutral one? Last week I did a panel and we were talking about the equity markets, and the consensus seemed to me among the speakers on that panel was that the equity markets actually now feel that that a Trump re-election is not necessary for the bull market to continue, for the equity bull market to continue. So it'd be interesting to see what your comments are on this, positive, negative, or neutral, a Trump re-election. Just a quick word, Sujata, on inflation. Is it going to return, and when?
Oh, that's $1 million question. Logic says it should, because given the amount of stimulus we're seeing out there, it's this time not just central bank stimulus, but fiscal as well. So logic says it would, and people are preparing for it. There's been massive buying of gold, for example, or things like inflation-linked bonds are very popular. I think people are even buying things like forests and stuff like that, which apparently hold up well during periods of inflation. But the downside is, again, well, it's down to coronavirus, really. How bad does it get? Do we get, again, lockdowns? Can the economy recover really to the way it used to go before? I mean, can trade recover? So all that, so if growth doesn't recover, trade doesn't recover, I don't see how inflation can. Except in some countries like some of the poorer countries where food plays a very big role in the inflation basket. So we might get inflation in places like India. But I don't see how in the next 2-3 years, I don't see how we can get inflation back to target, anywhere near target.
How are you reading the inflation picture right now, Martin?
Yeah, I agree. I agree. At the moment, I think it's going to be subdued across the board because these are unprecedented times. So I don't believe that that's going to be a factor in, at least in the medium term.
The polling question, I mean, positive and negative is pretty split. Neutral, 27% or just above 27% say neutral. Just back to this question of a Trump re-election. The people you speak to in the markets, Sujata, the people you speak to in the markets, Martin, and clients you speak to, Richard, what is the general consensus now? Not on who's going to win this, but on the way the market will behave if Trump were to be re-elected?
I feel that people are more worried, not so much about the people are worried less about the outcome at present.
Can you hear me? Go ahead.
Okay. People seem to be less worried about the outcome than about the fact that in-mail voting might create delays after the election in knowing the outcome of the election. And we might not know the identity of the winner for a few days. And that leads to kind of volatility, legal challenges, possibly a repeat of the Al Gore, George W. Bush situation. So these are all risks. So that's what people are really worried about. And as for Trump winning, I must confess that it could go either way. I don't know.
Yeah. Martin, what about you? What are you hearing? I mean, clearly the concerns are a period of uncertainty. If the result needs to be checked and double checked, if the result isn't accepted by one party or another.
So that would be that. I agree with Sujata. So in that, any uncertainty is not good. So in the past, what that would suggest is that you would buy the dollar, but as we've said, there are other factors that now and the potential rivaling with euro that could potentially muddy the waters here. But in terms of the outcome, let's say that the outcome happens and we have a Trump victory, then it could be argued that domestically it could be a positive, because what that would suggest is that there would be more market-friendly proposals from Trump continuing. And some people believe that perhaps the Democrats would be a little bit less favorable in that point of view. However, when you look at the foreign policy, with a Biden presidency, you'd have much more stability. So that in itself would basically equal out any negatives you would see domestically. So personally, from my point of view, I don't believe that it will make a difference who actually wins. At the moment, the polls are suggesting that it's going to be a Joe Biden win, but we are still quite far out. And people point to what happened with Hillary Clinton, but with Hillary Clinton, she was never as far ahead in the polls as Joe Biden is. And also, Trump was at that time an unknown quantity, whereas now he's president and he's the incumbent at a time of a pandemic. So my hunch at the moment, as things stands, is that the likelihood is that we will get a Biden win, but I don't think that will have a negative or positive effect on the US dollar.
Okay, and finally, Richard, how much time spent talking to your clients about this?
Obviously, being based here in Hong Kong, there is definitely a preference not for a Trump to continue. to kind of stabilize a little bit the rhetoric between the US and China. But I think most people are saying until the COVID piece sort of gets a little bit more stable, then it's just a calming of the rhetoric and people's minds, emotions, rather than really going to make a big change in the market at the moment.
Yeah,
COVID is the leader.
All right. Look, we hit the 45 mark. I am going to wrap it up, unless anyone has anything they want to add, just as a finishing thought. Anyone? In fact, there is a question just came through. Just so before I let you go, this is what the question is from one of the viewers. Do you foresee any policy changes coming out of the UK in the coming months to support sterling? Sujata, first you, Martin,
I doubt that there's going to be any policy change aimed specifically and specifically targeting sterling. That's not likely. What we might get is an extension of things like the furlough schemes, for example, which to support the economy and the employment situation. So we might get more stimulus, which fiscal stimulus, which I guess would help support sterling.
Mm-hmm. Martin, what do you think?
So the only thing I could say here, which would be ultra positive for the pound, is if there was some type of shift, which is unlikely, in the Brexit stance and the negotiations from the UK point of view. So if there was a situation where it seemed like there would be a deal which would have much more cooperation, then from that point of view, I think that would be very positive for the pound. But that's something that I'm not sure is actually going to happen.
Okay.
So overall, I think at some point we'll see a reversal.
Got it. Sorry, you were cutting out a little bit there, Martin, but I think we got the gist of that. Look, I am going to wrap things up. I want to thank all of you for your time and your views. Richard Pembleton from Refinitiv and the client perspective, thank you very much to you. Martin Miller, Senior Currency Analyst for FX Buzz, and from Reuters editorial, Sujata Rao, Deputy Markets and Financial Services Editor. Thank you very much for your insight. We hope you found the webinar useful. Do watch the space for webinars coming up. Thanks very much indeed.
Thank you.
Right.